Good morning. This is Mr. Not Advice. It is Saturday, January 24th, 2026. This is my weekend update. Got a couple of topics. As always, this is for education, entertainment purposes only. Got quite a bit to go over today. Let's take a look at the markets. This was although Friday was sort of a muted market, we had just a crap ton of geopolitical catalysts that happened this week. So we had, let's go through the list. Greenland, Trump effectively started it off with threatening the continual threat of tariffs and perhaps military action, which he then backed off of. We had Europe's retaliation threats over tariffs. We had Japan's 40-year long bond breaking out until they came in and intervened. Then Trump taco trade struck again, and because then he came out and said that everything's going to be fine with Greenland and NATO, so no problem. Trump then came out and said Iran, that there's an armada on the way, and there's been some chatter among some of the global leadership that there's imminent action in Iran. Of course, then we had Davos, where Trump dominated the stage, and it was more of a dressing down. One of the comments he made was talking to European partners was you'd all be speaking German if it wasn't for the US, which is true and not something that the elite of Europe like to hear, especially France. Then we had Trump continues to vacillate for his Fed chair pick. He wants to keep Kevin Hassett in his current role, and unfortunately, he's got Rick Reader's odds, BlackRock, which is, I think, a criminal enterprise. The Rick Reader's odds continue to rise that he'll be the next Fed chair, which is effectively like letting the fox in the hen house. But there's only so much. The world's not perfect, and it is what it is. Then, of course, we had the yen intervention. Bank of Japan had to come in. First, there were a couple things that happened with the long bond, Japanese 40-year up so much. Japanese central bank had to step into the market and buy bonds in order to cap these stratospheric takeoff of their 40-year yield. In addition, though, some good things that happened this week. We had U.S. macro data was better than expected with a strong GDP and consumer spending, and inflation pretty benign. And then we had near record lows for jobless claims. So if you, this first chart is, if you look at, this is US macro data since August, it's been the best 2-week surge in US macro data. And I suspect that could continue depending on the outlook as tech companies start to report. Remember, we've got the blackout period for stock buybacks by corporation. I believe it ends next week. As I was saying, this chart is, or the odds of BlackRock CIO becoming the next Fed chair, about equal to where Kevin Hassett is. So I think that's important because the market's going to take that. There was a commentary about Tom Lee. Tom Lee had said that he thinks the market's set up for a downdraft from higher levels because the new Fed chair will be tested by the markets. I don't know about that. Doing that and having done this for over 3 decades, I don't think that's a clear objective of either the currency or the bond market is to test the Fed chair. That's Tom Lee. He's been just stellar on his call for Bitcoin and Ethereum, by the way. Yes, I'm being completely ironic. Okay, so put that all together, and we had stocks lower. We had volatility higher. The dollar got smashed, and a lot of that had to do with the Japanese yen being supported. Precious metals continued to move to new record highs. We had crypto again was ugly, and crude up hugely with natural gas exploding due to the oncoming snowstorm throughout the Midwest and East Coast, even all the way down to Tennessee, which just makes me laugh. Treasury yields were higher, but not anywhere near as high as the Japanese government bonds. So we had rate expectations tumbled on the week, now well below, expecting two cuts this year of 25 basis points. So we'll have to see. If the economy continues to improve, especially especially the labor market, and interest rate inflation stays benign, it's going to be difficult for the Fed to step into the market and lower rates. Of course, I have to believe that one of the, or if not the most important question that Trump has for his incoming Fed chair candidates is, are you going to lower rates, and how low, and will you do it on day one? So I suspect they're going to run it hot, the economy hot. Equities this week. This was a crazy week. Here we go. Trump tariffs, right? In response by Sunday night, the response by Europe. And then we had the Japanese long bond breaking out to record highs. And then we had the taco trade, which was Trump saying everything's going to be all right. Right. So I'm sorry, this Tuesday, it was a shortened week. NASDAQ managed to hold on to some modest gains while the rest of the major indexes did finish in the red for the week. This is the S&P's first 2-week loss, okay, since June of 2025. And with the volatility that happened in terms of headlines, I'm pretty impressed that we aren't much lower. The Russell 2000, and this is should be concerning. Well, on a short-term basis, this could provide some downward pressure if this continues, especially into one of our core holdings, which is EOSC. There was Goldman's trading desk even commented that there was a notable change in the narrative today, and I quote that, with the Russell underperforming the SPY for the first time all year after it's been outperforming the SPY for a record of 14 days. So to be expected, yes, some rotation out, profit taking, and that was evident yesterday. And I'll go over one of the trades we took, which I have this list in my head that I refuse to trade certain things. One of them is natural gas. One of them is Abercrombie and Fitch. So different reasons. One of them is XBI, which is the biotech index. I think we've tried to trade it 3 times. We haven't made money in it. It's completely annoying to me because really trading the XBI is trading the Russell, because the XBI is made up of a lot of biotech companies that are not profitable. That would be smaller caps. I don't know if you have a list like that, but I do. I have a list where I just won't trade it, and that's on the list now. So mega cap tech managed gains on the week, rallying strongly. Here we go, rallying strongly off Wednesday lows, which is actually something new. Look at this. The Mag 7 stocks ended green this week while the rest of the S&P was red. That hasn't happened in a long time, yes? And then the one Mag 7 stock that really seems to be Meta sort of has paused this downturn, but Apple this was the 8th weekly decline in a row, which is the longest losing streak since May of 2022. Are we at a point to buy it? I don't know. I'll look at the technical charts. And in fact, this is retail cumulative purchases in the Mag 7 plus Palantir. And so at the very top, what do we have here? We've got NVIDIA, right? Then we have Google, and there's Apple. So everything else, it's about normal activity. Let's take a look at this. So the dollar was just killed on Friday, but that's the worst day since August. But I do believe that's a great deal to do with the intervention by the Japanese central bank into the yen. So I don't see that as being a permanent fixture. And here we go. The yen surged today to its biggest weekly gain since May of 2025. So you can see it doesn't take a rocket scientist, and you don't need to get into the minutia. Obviously, the dollar was sold and yen was bought as there was an intervention. So by the Japanese central bank, probably with a little bit of help from the Treasury. Gold is now up 5 straight days. up for 3 straight weeks, and we are near 5,000. This is gold's biggest week since the COVID chaos of March 2020. We also the rest of the precious metals also ripped higher. This is a chart of copper, gold, silver, and platinum. So precious metals will probably continue to move higher. Well, we had silver topping $100, hitting 102 at its peak for the first time. And a lot of that has to do to massive China demand. I think that's going to continue, not the massive China demand, but I think the commodity super cycle will continue. Different reasons offered as to why this is happening. One is the debasement of the US dollar. Another one is a flight to safety. I don't know. I'm not a precious metals expert. This is a chart of the EWZ ETF, and this is Brazil. So while we while it's I would expect that we're at the top end of this channel range, I would expect that there's going to be some sort of reversion to the mean. But every single time we've done that as of late, the dips have been a good opportunity to buy. So I'm actually going to put that on my chart. I'm going to take a look at this support level right here at about $35. And if we break that level to the downside, I will start looking at for a reversal. What's helping Brazil are commodities. Bank of America's Michael Hartnett, I think that's his first name, makes the comment about gold, that gold's secular bull market remains intact. If the Fed starts tightening again to combat a second wave of inflation, that probably, according to Hartnett, is the most reasonable risk that he can see. But there doesn't seem to be a near-term threat. So on average, the past gold bull market has delivered gains of around 300%, implying that this cycle's peak could be north of 6,000. This is a comparison of the 1970s US CPI right here to today's US CPI. This has to be taken with a grain of salt because it would be very easy to look at this and say, well, it appears as though that CPI is ready to start ripping higher. And that very well may happen. I mean, if Trump continues to lower rates, that could start an inflation cycle. But do I think that CPI inflation today is going to mirror the same trend and pattern as the 1970s US CPI? I think it's very early to try to make that assumption. We do know that Trump is going to try to run this economy hot. Lower interest rates could cause a surge in economic activity. So there is the chance that you would get a spike in inflation. And Trump is not concerned about that at this point. You've got the housing market appears to be starting to stabilize. Consumer spending remains strong, and even job losses have appeared to or starting to level off. So illegal immigration, I think, could be masking or the results of a reduction of benefits to immigrants in the U.S. could be interpreted incorrectly as growth because you're lowering the expenditure side of a cash flow statement for the U.S. government as well as for state governments and then ultimately taxpayers. I don't believe that would be correct to say, well, we're spending less. And the net effect is, let's say, more net income. Okay. This is at the government level. So therefore, as that net income goes up, I believe there's the possibility that that could be misinterpreted, add to the perception that we have inflationary pressures rising. So it'll be interesting to see how this all pans out. But that's sort of my comment on uh, inflation and what I think is going to happen. I don't, if we're going to have an inflationary push, I don't think it's going to happen until after the midterms. So not 6 months, maybe 3 months. So it's a lagging So it's a lagging indicator. So there's the other issue too, is the numbers we're picking up on are already old. And that's why the market is always looking for trend. So right now, the trend for inflation, the CPI index is actually sideways to down. It is not up. And this is not the similar type of economy that happened in the 70s, which was a very high inflationary period, but it was also accompanied by high unemployment too. There has been a continued retail, just unprecedented buying in the most recent weeks, which actually has led to the biggest 21-day cumulative retail buying on record. This is ABCL. The stock surged by over 30% between January 5th and January 12th. Now, this had to do with the phase 2 trial for a drug, but retail investors have been buying it since April of 2025. There was a very high level of short interest. So, could it get squeezed again? Yes. The retail buying did not happen in a vacuum. Obviously, there was an expectation. So I think there's a combination. You have to look at not only rising short interest, but also, is there going to be a trigger event? Yes. And that's going to cause a squeeze, as what happened here. Retail has been buying this since September 2025, 14 million in net purchases against a short interest of 22%. And that's up by 14% since September 2025. I would expect there to be, on the high beta names such as non-profitable tech or biotech or non-profitable pharmaceuticals, there typically is a large short interest. But I go over these because we have one of our stocks, which I think is sitting at 25% EOSE. And in the span, for example, here in the span of 3 months, stock went from $2.50 to 17.5. That's a big deal. Man, you can do the math on USC if that were to happen. So I don't think it's going to be similar where all of a sudden wake up and EOSC is at $100 a share. Okay. These are companies that they believe have the same characteristics relative to short interest as well as retail buying in it. So these could be, candidates for a short squeeze. And there's some pretty popular names that we trade actually. I'm always careful when I see this because, people talk about, I want to be in a stock that gets squeezed. Well, who doesn't? But to trade a stock just on the potential of a short squeeze, I think that short squeezes are outlier events as much as we would like to predict them. And I think more often than not, EOSC's had a large short position relative to the outstanding shares for 2 years, 3 years, and we haven't seen that type of short squeeze. So I think it's important not to misinterpret that. Oh my gosh, look at SLS Life Science. Actually, that one could get squeezed because it's a biotech. Has a 30% short interest. HIMSS has a 33, and we've got all the top ones are quite frankly biotechs and pharmaceutical companies. Just because of the short interest, are they going to go up? No. And I think that's one of those cases where investors can take a single data point and then curve fit all the other data that they see to support that. So the data point would be high short interest, therefore I buy. And so everything else I would look at would support that thesis. That's something that even the best traders can do. I have learned the hard way not to buy short interest stocks just based on that alone. If you're trading it, if there are other reasons to trade it or you're invested in it, then it's, if it happens, I think that is a higher potential, obviously, for those stocks that have large short positions, but it's not going to be the reason why it goes up. Short positions alone. There's always got to be a trigger event. So this was interesting that BlackRock cuts the value of its private debt fund. I hate BlackRock. By 19%. I think their NAV is going to go from over 8 to somewhere around $7. That's very nice of them, isn't it? They're waiving their fee. For those that are looking for a collapse in private equity, I think if a collapse does happen in private equity land due to crappy investments, then it's going to come out of the blue, because as bad as the 2008 crisis was, okay, private equity, they can hide all the garbage even more. They can play extend and pretend, which effectively means we're not going to realize losses. We can have capital infusions. We can, now, here's the one good thing is with a private debt fund, BlackRock itself is going to experience losses. Unlike a mutual fund or a hedge fund, private equity funds require principal investment from the principals. So whoever's running it, I don't think there's a couple people on Twitter that have been calling for the collapse of the mortgage-backed security market forever. And it could happen because when you look at it, it's, with the derivatives that are in it and the fact that they don't mark to market, certainly that lays the groundwork if there is a trigger event. Because what needs to happen is a private equity fund fails, and that causes that ripple effect throughout the debt markets, throughout banks. While there is the potential for a sharp drawdown in the private equity markets, and yes, they have sold a lot of garbage, and yes, they sort of work behind the curtain. There's got to be a trigger event. Okay. What could be a trigger event? Well, if a smaller PE fund that is leveraged fails and the lenders lose money, which would be other private equity funds, insurance companies, or banks, and if they themselves also have weak balance sheets, then you get that ripple effect. It's the very simplest example of contagion, which we heard all about in every single crisis, whether it was long-term capital management in the late 90s or the 96 or 97, or the 2008 crisis. There's got to be a trigger event. And I just don't see that we're quite there yet. Usually trigger events happen after you have just big runs, bull markets, where it's very frothy, and you've got companies taking on outsized risk because they've been doing so well. I don't think we're there yet. So let's say you're a private equity bear, okay? Or let's use a different example. Let's say you're a bear, commercial real estate, right? Which I think there's a lot of properties right now, and we've seen them, okay? We've seen properties being sold for pennies on the dollar. Properties that were 100 million, 5 years ago, going for 15 million. Why is that not collapsing the market, right? The commercial real estate market. It is, well, most of the reason is because we don't have on a lot of these properties, you have willing buyers that will come in and buy distressed properties, and money's fairly cheap right now. So while last year, I think it was 2024, right after COVID, bank lending sort of froze. Well, it just froze up. There was a healthy amount of lending going on within the commercial real estate sector, and its access to capital and lack thereof that causes big, corrections and crashes. I don't see that there is this frothiness in commercial real estate, and yet there are people that will pound the table about what a shitty condition commercial real estate is in. I would agree with that, but what are you going to do about it? What are you going to trade? And the other issue is, we have a bank expert in our group, Mr. White, is banks can play this game that I call extend and pretend, which is as long as they never realize the loss. So if you have a property, commercial real estate owner, and you can't pay your mortgage, well, bank can say to you, well, we'll give you a 6-month moratorium on interest rate on payments, and we'll just put it at the back of the loan. Why would a bank do that? Because the bank doesn't want to force you into foreclosure, because then they have to book that loss. So it's not to the bank's benefit to force borrowers in commercial real estate into the foreclosure process. It's to their benefit to extend and pretend and make sure that shit never hits their cash flow statement or worse, their balance sheet. So they can do that forever. It literally can be done forever. So it wouldn't take a major shock, right? Where a bank is forced to realize a loss. My point is macro and fundamental um, experts, and there's a number of people that I follow, I think are incredibly intelligent, but all they focus on is how bad it is, how bad it is. And eventually that's going to rise to the surface. And I'll be honest, I was one of those guys who used to think that about commercial real estate. Like this, this is garbage. I'd see the products go out. I'd look at the cash flow statements of the properties and like they're not covering their mortgage. We have rising taxes. We have rising operating costs, which compresses cash flow. And this shit's going to just, get flushed. Here we are, 4 or 5 years later, still hasn't happened. Why? Because banks are extending and pretending. Would I rather be right intellectually or would I rather make money? I'd rather make money. All right, let's take a look at some individual charts this week. All right, so we had the SPX this week closed red for the week. And if you zoom out here, really what we saw this week was more of a reversion to the mean. The SPX remains in a long-term or longer-term uptrend, and I'm gonna wait till we break 7,000 before I attempt to get long. Nasdaq market. Let's take a look here. Continues. Look, this is the same ceiling, the same resistance that thing has been struggling with, since way back here in October. So needs to punch through there with force. I think the stage is set or the table is set for that to happen because we're going to have tech earnings in the next 2 weeks. So I think tech earnings are going to be really dependent on the outlook too. Chip prices just starting to move. And as I said last week, if you're looking to buy a laptop or you're looking to buy a PC, I would do that now because I bet you, and we have a member who's very knowledgeable in this, that 6 to 9 months from now, they're going to both those products are going to cost double. And let's take a look. This one hurt us this week. That is a strong reversal off that all-time high. So I usually teach. My belief is these are usually 1 to 2 day or 2 to 3 day events, so we could see some fall through, and that's what hurt our XBI position. Right? This is ugly. This is an very close to an equal opposite at the top end. So we most definitely have a high probability for this downdraft to continue. But for us, because the way we trade, it's these small moves, we need a continuation of the trend only for 2 to 3 days. And when this happens on the first day of our trade, there's no shot at that. So we're going to take on Monday a loss unless we get a stick save on it. The Russell 2000 rolling over also hurt EOSE. We had this reversal down on not very, but pretty light volume, only 15 million shares. And I made the comment to our traders on Friday. I'm like, boy, it just seems very quiet out there right now. Yes, we are in NXE. We're up in this, but we're not up a lot. I don't know what we're up. So I'll probably be closing this on Tuesday unless we get a scale. We have a 3-day stop rule, but it's just sort of taking its time. The way I read charts is backwards. Yes, I do. That's what I teach, is you read charts backwards. So really right now we're sideways to up is the direction. We needed to break out. TXG got smoked on Friday, and this was probably going up because of crazy Kathy Woods. Ooh, I say that lovingly. We still, I think, will end up being flat to maybe down a couple percent. This is again, reading charts backwards, we have sideways to down. If the Russell 2000 bounces on Monday, which we very well could get because we should get a retrace against this big red candle, I will look to that opportunity to liquidate those positions at a better price. Looking at PCT, same thing. It's really in a consolidation zone right now, which it held up better than some of the other small caps that I track. NVIDIA continues to just chop around in this pathetic channel right here. Do I think that earnings will finally move it out of there? I don't know. I honestly don't know. This is becoming one of the most volatile stocks, Mankind Pharmaceuticals. I saw that and there was really no news. So that's a massive bearish and almost like a perfect bearish engulfing candle. Volatility is just crazy, right? I mean, we hit a high on Friday of almost $6, closed the day down at 546. And that's just a very, very large move. Meta, unbelievably, Meta is coming back to life. But what do you have? You have first the test of this point of control, and the second would be the 200-day moving average. So those tests are coming up. Again, I think it's going to be entirely based on earnings. INV is right now appears to be dead money, which makes sense because they just did an offering, and I don't have any. I'm glad I closed it. I'll tell you that. Number one, and two, I also think that they're doing road shows. They're doing road shows to the effect of getting the story out there, and until and unless they are able to sign additional contracts other than with Johnson Controls, I think the stock will remain sort of sideways to down. Hecla Labs, we've done well, and we are down to runners on it, up 75% in less than a week. And I'll continue to hold, not Hecla Labs, I always say that, Hecla Mining. We're doing very well. And as silver goes up, so will Hecla Mining. Okay. Google stuck again against this channel. Nothing to see here. I think earnings are going to either move it out of that range or not. NFX. NFX looks sort of sick right now. We've got, take a look at this. And I've seen this before, folks. We have descending highs against a pretty pronounced support level. If this thing breaks $7, I think it's going to have a problem. This year, by the end of the year, this stock will be at what? Oh, $3. $3. One of the so my outlook for next week, we're going to get into the meat of earnings season. I think what I'm going to be watching to see is what is the market triggering off of? Are they going to trigger off of 2025 results, or are they going to trigger off of outlook? And what part of the outlook that companies will be talking about will they be focused on? Are they going to be focused on AI and the AI spend? Yes, I think so. But how much of the chip shortage, supply shortage is going to factor into a lot of these tech companies' reports and concerns? Earnings reports are always this mixed bag. And so what I look for is what's the tone, right? What is the overall tone as companies? Are they upbeat? Are they downbeat? And so it'll be interesting to see as these tech companies, they're really going to they typically set the bar for the rest of the earnings season. And we've had mixed results, from the banks that have reported. It's just without knowing without knowing what the market is going to key on, right? I think it's going to be very difficult, or it is for me very difficult to take a guess at where the market is headed. Once I get a couple tech companies and I see how the market reacts to whatever the focuses of that tech company's earnings, we're very concerned, or we look forward and think, well, we've hit a slowdown in consumer spending. We see that there's a temporary slowdown. If the market rallies off of that, then that puts me gives me some confidence that the market remains very resilient. If, however, the market were to that particular stock were to move down strongly, that would tell me that we're still struggling with all-time highs here to make new highs, and the market is pretty nervous. So earnings are a crapshoot until you get at least the first couple companies reporting. So this is a proprietary website for my Fight Club members. And this is just part of it, but this is the auto screener that we use that searches the entire market every day after the close for my setups. And then members go in and they do a little bit deeper dive. But the nice thing about this is it actually models the trades for you, chooses the option and all of that good stuff. And we have specific metrics that we want to hit first on the protection of capital, meaning we have a max loss, and then we have a minimum gain. I've been doing a lot of review, and we're in the process of doing back testing of all my trades um, since I started publicly trading almost 3 years ago. I've got over 760 trades. And because I know that there are areas that I can tighten up in my methodology. And so I'm a data person. I go to data. And I've gone through this before when I had the quant fund. There is a point of diminishing return, meaning I can put a tremendous amount of time into the back testing and maybe squeeze out of it, perhaps instead of getting a averaging 64% win ratio or whatever it is, I can get to 66. Well, really? Is that really going to make a difference? Okay. No, it won't. Right. And you can go down this rabbit hole of tightening it up. And then what you end up doing is what I call curve fitting or even confirmation bias, where you literally gain confidence because you have done a high level of analysis and refinement, but it's really done two things. It's given you a false sense of confidence because, for the second reason, the environment in which you ran your back test in, not the environment, but the environment that needs to exist in order to achieve those returns is rare. Yeah. So you can say, well, whenever I trade XYZ and these technical data points exist, I can get this, extra 2% win ratio. And then when you look at the frequency of that or the probability of that environment to occur, it's rare, right? So I'm to be quite frank, I'm struggling with that now because I know that one of the base principles that I trade off of is using standard deviations and projecting out. And I've always said I've had a mismatch in terms of time frame versus looking at how far and how much the stock price can move in my favor relative to the stop. Okay, and we do these calculations. We look at project the stock price movement based on the IV and a couple other data points. And then we take that and then project what that particular option price will move. Okay. And that's really, a broad or a very simple explanation of my methodology. So we're going through this back testing. And as I said, I know there are things that I've done it this way for almost, 3 decades. Because before I had the Discord group and before had members paying me to teach them how to trade, I never gave a lot of this a hell of a lot of thought. I just traded this way. I'd see patterns. I'd see support and resistance levels. Now I am the only person I know out there that reads charts backwards. I just didn't give it a lot. I didn't think about, well, what's my R factor or what's my win rate, because I'm sort of an absolute I'm an absolute return guy. So I'm simply looking, as long as my account continues to go up and it's appreciating significantly more than the overall market, I feel like I'm doing a good job. But I'm also a data guy. So I've always had these questions. There's a balance, I guess, is what I'm saying, between as you're going through your methodology and you're looking to fine tune things. Oftentimes you can spend a lot of time fine tuning a part of your methodology that at the end of the day you've maybe curve fit or you is not going to have a significant overall effect on your portfolio, and in fact is going to perhaps limit your trading because now you have I used to trade with only stocks that had 25 IV, but this tells me I need to trade stocks that have 27 on average. Okay. I mean, I'm using hypothetical here, but I like to make this statement. as traders, we can sometimes get caught up in the analysis part of it, and we feel good about it because we've done all this work and look what the numbers say. And no matter what your methodology is, okay, if you're a successful trader, there is an art to what we do. We are never going to be able to replicate um, the unknowns. We're never going to be able to replicate the frequency at which those outlier events happen. So there is a balance. And, for me, I can go down that rabbit hole where I continue to pursue perfection when when in fact my returns are superior to the market. And there are just some things that you cannot explain, the art side of it, the unknown side of trading. And I guess I make this comment as I'm going through this process now where I have people, I have members that want to do this. I want to do it. I want to look at my back testing. Um, I was some of the numbers, some of the early data that's coming out, it confirms my base thesis in terms of using standard deviation to calculate projected moves. However, there is only so much data crunching that you can do. There is a limit, and beyond that limit, you're not going to add more alpha. And there are always going to be things within any trade methodology that cannot be quantified. Okay. Because just as you look at a stock, you look at the chart, or I do, and you look backwards, right? Historical performance, and you can get some idea of broad ranges, let's say. The same thing goes for looking at a trade methodology, because what end up doing is reducing your actual ability to trade because you've run numbers and put these computed variables, right, results of the analysis that are now constraining you from taking trades because the numbers say, well, historically, this is the average, let's say the average R, right? Or the average absolute gain of your winners. So therefore, I'm only going to look at XYZ data points that have the highest probability to produce that average return. You need to be careful in doing that as you examine your trading methodology. I mean, if you don't have one, get one. Your first step, I would be telling you is, well, not advice, but if it were my money, would be protect your capital, learn how to size. Absolutely take stops if you set them. If you don't set them, then you're really not a trader, you're a gambler. Learn to scale for profits and learn where those areas are. And those are some of the things we're looking at in terms of for the back testing is, since stocks move differently, each stock has a different personality, moves, with different speed. Instead of just a base scale number, is there a way for me to define, okay, a better metric that I can measure that tells me when to scale? Doing a lot of analysis on previous trading history, there is absolutely a declining. At some point, you are over analyzing the situation. And I'll give you one specific reason why. Because the economic and macro environment, previous periods, 3 decades of trading was absolutely different every single day than it is today. So how do you measure that? You could pull on a shit ton more data, or you accept that and limit intellectually the results of your back testing because you have a major data point, which is the macro environment that is different. It's near impossible. I think it's impossible to measure all the data points that make up macro, right? When I talk macro, I'm talking about economics, right? What is the state of the economy in whatever sector, whatever you're trading? It's never the same. It's always changing. And you can try to pursue a methodology that says, well, I want to be able to react to that. I think that's a fool's errand, right? I do think it's useful that, hey, when XYZ economic, rising inflation, rising unemployment, that should cause you to perhaps would cause me to dial back risk, to try to modify your trading plan in the absence of accepting the fact that there's going to be much more data that you cannot measure and that will not be consistent. I think that is very foolish. And I've watched it hurt very good traders who decided they were going to analyze every single data point. And I guess the reason I share is I'm going through that process now. And so there's this mental tug of war going on, push and pull of, how deep do I go? At the same time, making sure that I'm looking at enough relevant data points that could add additional alpha to the performance that I do. But with almost 3 years up, cumulatively over 640, 650%, I have said to myself many times and to my members, why would I do that? Why would I do that? And so I wanted to share that with you because I think in order to be good at anything, there should always be a self-evaluation process going on, right? Whether you're valuing yourself and how you execute the plan or what your plan is. And I do that. But there's also, again, there's that point of diminishing return where you can get comfort from the analysis itself and the sheer amount of data that you're measuring. But it's really not going to add a hell of a lot of alpha, either from a protect capital standpoint or from an absolute return standpoint. So I'm sorry, I'm belaboring this point. I guess the takeaway would be whenever you're doing a look back on your history and your methodology and your trading plan, if you don't have one, then that's completely irresponsible and stupid, quite frankly, and you're putting money at risk in the market. Seriously. But for those of you that do, because my team members and students, they take the base methodology I teach them, and many of them make it their own. They trade differently. When you're doing that, number one, accept that there's just some things you can't measure. Number two, as I said, about economic data points. Also, always be careful that what's giving you confidence is not the sheer amount of work that you've put into the back testing. Okay? It's a rabbit hole that you can go down. Also, be cognizant of more data analysis does not mean more success. And then finally, the best traders, and I don't put myself up there with the best traders, okay? The best traders understand there's an art. There simply is an art to it. I think it's Ray Dalio who said he never buys puts, never buys them. I think it was him. He only goes long the market. If you analyze that statistically, you'd say, look how much money you're leaving on the table, right? And there's that balance between analysis and the art of it. I felt like I wanted to share that with you all. Probably talked about it way too much. Looking forward next week, I'm pretty excited as our build out of the back end of our website continues. Video lessons are coming. AI agent is coming that's been trained LLM on my content. And yes, I am worse than GTA 6 with my delays of my book, but I want it to be good. So I want it to be great. So hopefully by the end of the first quarter, they'll come out with a workbook. So I'm super excited about that. Have a great week. Have a great weekend. If you're in the blizzard, I'm just kidding. If you're in the snow part of the country, stay safe. And I look forward to talking with you next week.